Welcome to The Explainer. Today we're going through the all-weather wealth blueprint, how to stay rich and survive market panics. Now, I want you to imagine something for a second. Imagine waking up tomorrow morning to the breaking news that the stock market has just completely crashed. Picture the scene, right? Your coworkers are absolutely panicking, your friends are frantically selling off their investments at massive, painful losses, and everywhere you look, people are just terrified. But you're just sitting back, peacefully sipping your morning coffee, going about your day completely unbothered. Why? Because you know your wealth is structurally protected. Today, we're unpacking exactly how to get to that point. We'll explore the behavioral science of why people literally lose their shirts, and we'll break down exactly how to build a financial fortress that thrives in absolutely any economy.
So, to really understand how to protect our wealth, we first have to ask a core question. Why do incredibly smart people go completely broke? I mean, you see it all the time, don't you? People with advanced degrees, brilliant careers, super high IQs, making absolutely disastrous financial decisions. Well, it turns out wealth destruction rarely has anything to do with bad math or a lack of intelligence. The real culprit is entirely different. It basically comes down to emotional reactions, destroying wealth way faster than a calculator ever could. When the economy gets tough, emotion grabs the steering wheel, and logic just gets shoved right into the trunk. Let's look at how this builds into a specific biological wiring that, honestly, we all share.
It all comes down to herd mentality. When everyone around you is panicking about an economic drop, or on the flip side, bragging about massive overnight crypto gains, your brain is actually biologically wired to copy their exact moves. It's a survival mechanism. It's baked deep into our DNA. Think about it. Thousands of years ago, if the rest of your tribe started sprinting away from something in a sheer panic, it was a really good idea to just run with them. You didn't stop to ask questions. But today, in the modern financial markets, that exact same biological urge causes you to blindly copy the extreme greed or the extreme panic of the crowd. And let me tell you, that is the absolute fastest way to lose your money.
Okay, let's dive into this psychological glitch. Mathematically speaking, $100 is $100, right? But biologically, they are worlds apart. Gaining $100 triggers a totally normal, pleasant little hit of dopamine. It feels good, but when you lose that exact same $100, your brain registers it with twice the psychological pain. Let that sink in. Losing literally feels twice as bad as winning feels good. This crazy imbalance is exactly what triggers that herd mentality panic we just talked about.
And this phenomenon actually has a formal name: loss aversion. This isn't just some totally random theory either. It's a proven biological glitch, demonstrated by the Nobel Prize-winning research of Daniel Kahneman and Amos Tversky. They showed that because of this intense biological wiring, the fear of losing heavily outweighs the pure logic of potential gains. And this is exactly why highly intelligent people completely lose their nerve. When the market drops, they feel that amplified pain, they absolutely panic, and they sell everything at the exact worst possible time. Or, and this is just as dangerous, they avoid investing altogether, because their brain is biologically designed to protect what they already have rather than logically pursue what they could have.
So, the absolutely crucial takeaway here is recognizing a fundamental difference. Getting rich and staying rich are two completely different games. The skills you need for one will often totally sabotage the other. Getting rich usually requires taking some bold risks, right? Swinging for the fences, maintaining massive, almost irrational optimism. But staying rich, wow, that requires an entirely different mindset. It requires discipline, it requires a lot of caution, and above all, it requires a deep, abiding respect for the downside.
To really drive this point home, look at this incredible real-life contrast. On one side, we have Richard Fosconi. This guy was a Harvard-educated investment banker. He lived in a massive mansion, had a 7-car garage, the whole shebang. He was brilliant at the getting rich game, making these huge, flashy bets, but he completely forgot to protect his downside. During the 2008 financial crisis, he lost absolutely everything to bankruptcy and foreclosure. Now, let's compare him to Ronald Read. Ronald was a humble gas station janitor. He drove a secondhand car, but he quietly and methodically invested in boring, everyday blue-chip stocks for decades. He totally mastered the staying rich game, and when he passed away, he left behind an astonishing $8 million fortune. No way, right? But it's true.
And this brilliantly illustrates a core tenet from legendary investor Warren Buffett. The first rule of compounding is to never interrupt it unnecessarily. You see, you really don't need to be a Harvard-educated genius to build lasting wealth. You just have to stay in the game long enough to let the math work for you. Fosconi's flashy gambling interrupted his compounding permanently. Reed's quiet discipline, on the other hand, allowed his compounding to just snowball, completely uninterrupted, into millions. So how do you actually stay in the game without losing your mind to anxiety when the news is terrifying? How do we actually bypass that biological trap of loss aversion? Well, you do it by building what billionaire investor Ray Dalio and author Tony Robbins call the Sleep Well at Night portfolio. This is a framework designed specifically to give you stoic detachment. It basically allows you to completely ignore the chaos of the crowd and treat market volatility as just a predictable, harmless part of the game. But before we build it, we have to look at the ultimate wealth trap. Most people treat investing like a casino. Step 1, they put all of their money into one single basket. Maybe it's just tech stocks or just one single piece of real estate. When you do this, your financial life is basically like sitting on a chair with only one leg. Sure, it might look stylish for a minute and it might promise quick profits, but look at steps 2 and 3. The absolute second the market shakes, that one-legged chair completely collapses, leaving you flat on the ground along with all your hard-earned money. To survive, you absolutely must upgrade your furniture to a chair with 4 sturdy legs. And that brings us to asset allocation. This is the antidote to the one-legged chair trap. Asset allocation simply means dividing your money across entirely different asset classes so that they naturally balance each other out and protect your downside. You aren't trying to guess which single investment is going to win. You're ensuring that no matter what happens out there, your wealth is structurally supported.
Think of it this way. Imagine you're a general and you must deploy your money strategically, just like an army. You wouldn't send all of your troops to fight in one single valley, right? That'd be crazy. You send different soldiers to different fronts. When you build your portfolio this way, losses in one area are naturally protected by the strength and victories in the others. If the stock market front takes a massive hit, your property or commodity front holds the line. Your 4-legged chair is not going to fall because its balance is maintained from all sides.
Now, what's really interesting about this slide is seeing exactly how a billionaire actually structures this balance in the real world. Notice the deliberate spread in Ray Dalio's famous all-weather portfolio. We've got 40% in bonds for that steady stability, 30% in stocks for growth, 15% in gold, serving as a historical hedge against inflation, and finally 15% in cash or commodities for ultimate flexibility. Even if the stock market crashes entirely, 70% of your wealth is sitting securely in completely different asset classes, actively offsetting the panic. This is literally how you sleep through a financial storm. The beautiful truth of this entire explainer is basically summed up right here. Control your reaction, not the market. You can't control interest rates. You can't control global events. And you certainly cannot control what the stock market does tomorrow morning. But by diversifying your assets into an all-weather structure, you absolutely control how you react to it. You don't need to reinvent the wheel to become wealthy. You just need to follow the framework the world's most successful stoic investors have already used to protect themselves from their own emotions. Which brings us to a final, absolutely critical question for you to consider today. Ask yourself honestly, what is one asset class you have been ignoring that you will add this month? Are you currently sitting on a one-legged chair of just stocks? Or maybe just cash that's silently losing its value to inflation? It is time to stop letting biological glitches and emotional panic dictate your financial future. Take the lesson of Ronald Reed, apply the structure of the all-weather portfolio, and give your financial chair another sturdy leg. Start building that unshakable wealth today. Thanks for joining me on this explainer, and I'll catch you next time.